today we're going to talk about some amazing things because it's been a wild effing ride in the markets the last week. Has it not? Any one of you looking at your portfolios? Is it up? Is it down? Are you sideways? I bet you most people haven't reacted and haven't prepared for what's been happening, and you have lost significantly because the markets have been selling off, but it's been a crazy ride. The markets will be down 1,000 points, then they'll finish up 60, then the next day they're down 800, and then they finish up neutral. How can you have 1,000-point swing in one day? Well, that's exactly what we're going to talk about today. We're going to hit inflation. We're going to hit the markets. We're going to hit the coming storm. Stay with us. We'll be right back. All right, welcome back to What the F Happened, a weekly review of the markets in the past week where we rant, we rave, and we argue all about what the hell is going on out there. Steven is my co-pilot, my partner in crime. What's up, Steven Snaggy?
Hey, good morning. Good morning. Just wrote down some statistics. Over the last month, the Dow Jones is down 5%, the Nasdaq's down 15%, and the S&P is down 9%. And many are saying this is just the beginning. But we got big announcements coming from the Fed today at 2 p.m. Eastern. So they're supposed to announce what their plan is for this coming year. They've alluded to they plan on some rate hikes. What that's going to look like, we'll find out more at 2 p.m. Markets are waiting, but it's a crazy time leading up to this.
See, he's ringing the bell. He's like, Dad, there's someone coming. And that someone coming is the boogeyman. Someone coming is the end of the cycle.
Yeah, I got some people working on my house today, so I might have a couple barks, but we'll do it. My dog's fired up. I'm fired up. Chris, you're fired up. Ready for a good show.
Absolutely. So where do we even go to start this? I mean, all of you, unless you're living under a rock, have witnessed what's been happening here. We've been talking about this for years. A lot of people are like, yeah, that's what you said 2 years ago when nothing happened. Oh, well, you know what? My crystal ball, it's at the repair shop. It stopped working and they just can't figure out what's wrong with it. You can't time the market. You never can. You'll never get it right. You'll never get the top. You'll never get the bottom. The best thing to do is follow the cycles and the patterns and the signs, and that's what I do. And because I do that, I am prepared. Man, oh man, am I ready for the storm. We just got 36 inches of snow here in Buffalo recently, and we had our house all ready. We had our plow guy doing it. We had salt, we had food, we had water. We were prepared, but you know what we're even more prepared for? The big storm. What is the big storm? Is it going to be the next Great Depression? Is it just going to be a similar glimpse to the dot-com crash with a mix of the 2008 recession? Steven, what were you just putting up on there? Let's see what you got there. Buckle up. 3 months before housing crash, before the dot-com bubble. Explain this chart here. I'm going to show TikTok what we got.
Yeah, so you're just talking about the cycles, and I saw this yesterday. So on Monday, the NASDAQ had an over 4% intraday swing from a loss to where it closed into a positive. That happened on Monday. The last time that happened was the 3 months leading up to the housing crash in 2008. And the time before that started to happen was right before the dot-com bubble and collapse we had back in 2000 and 2002. So just talking about cycles and history repeating itself, we're going to talk a lot about that today because all the warning signs are starting to point that way. So we can see what happened with the dot-com collapse, with the housing crash, and now we're starting to see these crazy volatile swings intraday happening right now.
Wow. All right. So that's just one sign, folks. And boy, oh boy, are there lots of signs out there that show you exactly where we're going. But the easiest ones to look at are just going back in time and looking at history, going back to the roaring 20s. Hell, you can even go back to 1918, which was the Spanish flu, which very much resembled COVID. And then you can see what happened after that, the roaring 20s, which would be very similar to, you could look at several periods, in between. Could be the 2000s before the Great Recession happened, but you could also parallel that back to what's been happening now. But I think what you're seeing now is very reminiscent of many other time frames. And it's interesting because people don't quite understand this. You know, we've been in such a long bull market that a lot of people don't even realize that this bull market could ever break. A lot of people are thinking it can't go down. The government will just print more money. Well, the government tried printing money. Because right now, if you look at the numbers, and there's a great white paper, you guys can all get it by going to economicprinciples.org, economicprinciples.org, and you can read the white paper that Ray Dalio did on paradigm shifts, and it will literally sum this all up for you. But if you just look at what has happened. So we came out of 2008, which was almost a complete collapse of the financial system. They printed lots of money. They barely saved the entire banking system. And then what happened after that? Well, we've seen a bull market. And then that was followed by COVID. And COVID, the pandemic, resulted in shutdowns, which resulted in basically killing the economy for that period of time. The government dropped interest rates first. They took rates from where they were, pulled the lever, hit zero. That same thing happened in 1934. That same thing has happened so many times in history where the Fed drops the interest rate lever, makes it really cheap to borrow money. All of you are enjoying low rates on your car loans, low rates on your mortgages. A lot of you are refinancing. You're loving those low interest rates on your home equity lines. This is what they do to stimulate the economy. It gets people to basically see a false sense of reality due to credit. So when you see that, everybody feels rich. Everybody's got money. It's easy to get money. They all feel like they have lots and lots of money. And I'm just saying, this might be you. You feel rich. You feel like, wow, things are good. For the first time in a while, I have extra money. I have credit. I can buy whatever the hell I want. I'm making good money. The pandemic wasn't so bad. Yes, COVID sucked, but you know what? The economy's doing great. No, the government printed, $5 trillion? And the government didn't print it. The Fed prints it. The central banks print it. And then they exchange it to the government in return for debts. So it's an exchange. Money out of thin air, okay, the printing press, exchanges for debt. And then all is good. And the government then gives it and puts it into the economy in various ways through stimulus plans, PPP loans, EDIL loans, your quantitative easing and all that stuff. So you got all this happening, but now everybody's got lots of extra money. I think a lot of the extra money people see today isn't real. It's because they're not paying their student loans because they're deferred. It's because a lot of the debts that they have, quote, debts, remember, credit is debt. A lot of the debts that they have are not being paid or were not paid for several years. So that resulted in them feeling like they had extra disposable money. And what did they do? Well, clearly they bought shit. They went on Amazon. They went on all the sites. They bought lots of stuff, which resulted in a supply problem. You had more demand than you had supply, which is all the ships out in the harbor. That's starting to come to an end. All these things are cycles. They all come and go. And you're starting to see all these things start to kind of go. But the big telltales, and we're going to hear more this afternoon with the Fed, the Fed announcement at 2 p.m., but the prior Fed minutes said something very important. I want you to pay attention. Then I'm going to go to the board and explain the cycles. The Fed said that they're going to do what? Raise interest rates. How many times? Is it 3? Because the market's expected interest rates to go up. You got over 7% in inflation. You got to start to cool that down a little bit. And the only way to do that is make it more expensive for people to borrow this easy money, this cheap money. So they're going to raise rates. But is it going to be 3 times? Is it going to be 4? Is it going to be 5? Is it going to be 6? Which is it going to be? 3, 4, 5, 6? Who's the highest bidder? It's probably going to be a lot of times. And a lot of people will say, the reason they're raising rates is to cool inflation down. Yes. But if you really look with a magnifying glass, I think there's a bigger story that has to be told about interest rates. And Stephen, I'm going to get off this little tangent in a second, but when the markets fall, when the economy collapses like it did in any of the other periods of time, I don't care what period, every decade you have something like this happen. What is the first thing the government does to curb and to stimulate the economy? And just so everybody knows, I don't know if you guys know, this is our Shopcat TikTok. This is Cash. There you go, Instagram Cash, and everybody else. This is our lazy Cash. And he's lazy because he's a cat. Cats are all lazy. But he just hangs out here and he loves being part of every show. So anyway, back to that. So they're raising rates all these times. Is it just to curb inflation, or does the Fed and the U.S. government see the storm coming like I do? Do they understand that we are at the end of a cyclical cycle? Which one? The long-term debt cycle. The last time that long-term debt cycle could be counted from is the Great Depression, about 1932 to 1934, depending on where the clock starts. Going forward to 2022, how long is that? Someone do the math. 75 years. How long is the long-term debt cycle that's behind me? 75 to 100 years. We're at the end of that cycle. We're also at the end of the capital cycle. We're at the end of the short-term debt cycle, which you've all seen. It's those quicker ones, the 5 to 8 year cycles. You've seen those happen. .com crash, 2008. Do the math. There you go. Short-term cycle. And you're seeing telltale signs of what's to happen next. You're seeing political divide in this country. That has happened every other time we approach the end of a cyclical cycle. What else are you seeing? High debts. Okay. The debts that the government has, all the liabilities the government has, from Medicare to Social Security to, all these debts that they have to the Fed and to all these other countries. How much is that? Well, if you look at GDP, by the math, it's about 1,100% of GDP. Does that make sense, folks? Can you guys go out and spend 1,100% more than what you actually make? Because that's what the government's doing right now. But they won't tell you that. You have to actually look at the white papers on paradigm, the economicprinciples.org. So these are some of the signs, and there's more. How about Russia and Ukraine and our magical president and our government saying, "Oh, we're gonna give severe consequences." Really? Do you think Putin takes that dude serious? Can't even mutter a sentence. If you were Putin, would you be looking at him being like, "Yeah, he's the real deal. I'm scared. I'm not going to do nothing." No, Putin's like, "Hey guys, get closer to that line. Put your foot over and take a picture of that and send that to the US. Let's just see what they do." "Oh, you're going to be facing severe consequences." Don't poke the bear, man. Don't poke the bear. Do any of you run out into the woods, find where the bears sleep, go in there and start poking them? You don't, do you? You don't want to wake that son of a bitch up. Well, we don't really want to do that to Russia, and we certainly don't want to do that to China, because we used to have the strongest military in the world, the largest military in the world, and we still do to some regard, but we don't have the biggest military, and we don't have the biggest economy anymore. Can anyone guess who does? China. China has the largest military. China has the strongest and the biggest economy that there is. Whether you like it or not, they do. The U.S. does not anymore. So all these things just lead to the conclusion of something's happening, folks. This volatility you're seeing in the markets, not normal. The markets don't swing 1,000 points in a day. Unless you think that that's normal, then you need to study a lot more. So, Stephen, that's kind of where we're at. This shows it back here. I don't know. Where should we go from there?
I mean, a couple of things on that, Chris, right? I mean, you brought up a lot of really good points there. I just wanted to kind of hit on with you there. And, talking about China, just since you left with that, I mean, they are definitely gigantic and it's amazing, their economy over there, but it's built on so much debt and smoke and mirrors that what's scary about it being so big is that if it does fail and things do start to crash, how that's going to affect us and everything that we have in our economy and here in the United States as well. So that just makes it kind of scary. I mean, you talk about Russia, we talk about all these sanctions and everything we're putting on them, but when we look at what we're actually doing behind the scenes, I mean, 3 years ago, we were purchasing 18,000 barrels a day from them. We're now up to 206,000 barrels per day coming from Russia just, 3-4 years later. So, what's really happening over there? What's really going on with some of this stuff? I don't know. I'm just asking the questions, but I think, where you started out with the Fed and everything that's going on right now, that's so very important. I mean, we have to remember inflation's running away. The Fed's job is to control inflation and control jobs. The way they do that is through controlling interest rates and through printing money. They've been printing money over the last couple of years, over 60% of the entire United States supply of money all over the last couple of years. So they're printing like there's no tomorrow. And then when you look at interest rates, I mean, the Fed average interest rate over the last 41 years is 4.75 points. 4.75 is the average rate over the last 41 years. We've been sitting at 0 to 0.25 rates for the last how many years now? And they're not upping it. So they're finally saying they're going to, but are they going to? I mean, because, what we're seeing and what they're saying, it seems to just change every single day. So let me just kind of show you how this is affecting everything going on. So I saw this article come up, Chris, and it's just talking about how mortgage refinances are down right now. And why this is important is what you said a minute ago. When everybody has money, they're out there spending more money. When you can borrow money cheaply, you're out there putting it back into the economy. When you can refinance, I mean, how many times, Chris, do we talk to people every day and they have a huge HELOC or they just had a huge cash out refi where they now have 6 figures or more money just sitting there. And they're like, what do we do with it? Well, when you have money sitting there and you're earning 0 in a savings account, you have to put it out there. So you either put it into stocks, you buy more real estate with it, you invest it, or you just buy consumer stuff with it, right? Whatever you're doing. But so as we see mortgage refinance rates start to come down because interest rates are starting to climb, that's less money that's out there for people to either invest or spend. And that just has a snowball effect on everything. So all this stuff is so very connected. So what's going to happen today when the Fed comes out with these announcements? I think it is built into the markets already with some of these downturns we've seen. And I can talk a little bit more about that also, but it just goes to show you how it's all connected. And before I pass it back over to you, I just want to share one more thing, because it's hard to go, like, where do you go for news? And I just want to show you what I'm talking about here.
Hold on.
So this is an image.
This is important.
Yeah, so this is an image that popped up, and it just shows, this was yesterday, Tuesday, January 25th, 2 different headlines from 2 different news agencies. One of them simply says retail investors bought $1.36 billion in stocks on January 24th. The other one says, throwing up the white flag, retail investors dumped stocks at Monday's open, JP Morgan. So one says that retail investors are buying billions of dollars worth of stocks. And in the same day, another analyst is saying that retail investors are dumping all their stocks. So
they're probably both right,
on the markets?
They're probably both right. There's probably some people buying and some people selling. You know, the people buying don't really know what's going on because they're not paying attention. The people selling, you know, who's really the ones you should be looking at is not retail investors. You get a false sense of reality when you look at retail investors, because usually that's the masses. When you really need to be looking at is the big money. Just yesterday, and if any of you haven't followed my shows, I have a podcast called Money School Podcast, and I have a really good show, a celebrity show called The Chris Naugle Show. Both of them are on YouTube or anywhere you see podcasts. But just yesterday on the podcast, or on the Chris Naugle Show, I had pretty much a legend in the hedge fund space. You know, it was very difficult to get this gentleman because these guys don't do a lot of public appearances. He's in the UK, he trades on the London Exchange, and he's worked for 2 massive hedge funds. He was on the buy side of it, and he did the research for a portfolio of about 19 different stocks in these hedge funds. And he's the guy that did all the analysis. And a hedge fund doesn't do analysis like the average retail investor. They don't get in the Uber and the Uber driver says, oh my God, did you look at XYZ stock? It's going to the moon. Or did you see this NFT? Or did you see that crypto? They're going to the moon. That's not what hedge funds do. Hedge funds do deep dives. They look at the balance sheets. They run pro formas. They analyze the numbers. They dive deep into the company. In many cases, they actually fly out to the company headquarters. They meet with the team. They meet with the executive team. They look at the operations. They say, is this team the right team to get this company, you know, to the next level? That's how hedge funds do research, months and months of research before they take a position, because they're taking $100 million positions in these companies. But the average person doesn't do that. Hedge funds, if you really look between the lines, they're not buying shit right now. They're having a very difficult time. I mean, look at the big ones, Blackstone, BlackRock. Where are they putting their money? Real estate, because they've run out of options in the marketplace. There's very little value. And a hedge fund, and all of you should be really looking at risk versus reward. Does the reward outweigh the risk, or does the risk outweigh the reward? But if you look between the lines and you analyze any stock out there, I'm sure there's pockets of values that are still there, maybe in pharma, maybe in healthcare, maybe in some companies that had poor management, but very few. You have to look really hard. It's like a needle in a haystack. So what they've done is they've moved to different asset classes to diversify and to find additional value. Hasn't worked so well for some of them in the terms of real estate because they're overpaying. And they thought that they could manage these large portfolios, and they're having troubles. But I'm just saying, hedge funds are flushed with cash. Warren Buffett's sitting on more cash than anyone else. If you look back, you will see all the different stocks that people like Zuckerberg, Gates, and Warren Buffett, it's all public knowledge. The stocks that they were dumping last year and probably straight through to now. I haven't really been looking at it. You can see it. It's all public knowledge. Why are they selling when you're buying? And I'm going to go over here to a couple things that came through, because this is important stuff. And somebody did call out and did the math and got me on something, and they didn't get me, but it actually makes the point even more valid. So they were talking about that time frame, and I was just sort of just throwing out time frames. They did 1934 to 22. That's 88 years, not 75. Holy shit, throw the warning bells up. Thank you. That was D-Core's on TikTok here.
And Chris, that goes to show what everybody's been saying, why we haven't had a bubble pop already, why we haven't had a comeback down already, because it's just being pumped up and being extended and extended and extended. But when you keep blowing into a balloon, eventually what happens? It gets bigger and bigger and bigger until what? Until you have that massive explosion. Right. You're not just letting it slowly out, the air slowly out like a normal cycle would do. Because of everything the Fed has done, it just keeps it bigger and bigger. And that proves the point. Instead of 75, we're now at 88. So that balloon, instead of 75, is now 88. How can we go?
Yeah, and if any of you are looking like this cycle back here, this is showing you the cycles, and this is as per Ray Dalio. He's explaining that the leverage period, which is the long-term debt cycle, is 50 to 75 years. By the math, thank you, Decors, we are at 88 years. We are way past, but that's because of the government printing excessive amounts of money, and it makes you question a lot of things when you really look at it. It's a scary time. So thank you for that. And the reason I got the time wrong is, number one, I didn't do the math, and I was just picking the 75-year cycle here, but that's number one. But number two, it depends on where you start measuring from. That white paper that I was going off of was a few years old. So I missed a few years there, but yes, 88 years. And then somebody else said 1,000 is normal actually in high inflation. I don't know what that's referencing. And then somebody else was just talking about our military. Absolutely, man. Don't fuck with the U.S. government or the U.S. military. Like, we got some badass people there. I'm just saying we just may not have the leadership that we would need to get us through that. I mean, does the military really, want? I don't know. I don't want to make a conclusion there. I certainly feel that the United States.
I could get into that, but we should probably stay out of that.
Yeah, the United States of America is the greatest country on earth, hands down. Our military, and I've got lots of friends in the military and that served, greatest human being.
If we didn't believe that, Chris would not be talking about U.S. long-term treasuries so much and make it such a significant part of an all-seasons portfolio. That's saying that we 100% back the United States all the time if we're dumping the majority of that all-seasons portfolio into long-term treasuries.
Yeah, and I'll just go to the next slide. Not this one, where we are now. This is stuff from the 3-day training, so I'm just kind of, just pulling up some stuff. But this is the next thing I'm gonna go into. What happens in times like this, and you could go back to any other time. I might be, blending some different time frames in there. So there's a couple of people saying not everything you're saying is correct. Well, it's just because I'm just blending, from 1920s to 2022 very quickly. I have it all written down. I'm just not staring at notes. So sorry if I missed a few dates and some of the information is blended, but you get the drift. Okay. So don't hold me to that. Like some people on TikTok are. It's awesome. But here's the deal. When interest rates are at historic lows, safe asset classes, like think of a safe asset class. When times are bad, when people are fearful, where does money flow? The flight to safety. Okay, as an advisor of 16 years when that's all we ever talked about, flight to safety. In every recessionary period, money flowed to the safest place. Savings accounts, bank accounts, because they're FDIC insured. CDs used to be a big thing. Okay, safe, guaranteed. Treasury bonds, guaranteed by the U.S. government. And then obviously what we always talk about, the privatized banking policies, which are specially designed and engineered whole lives. Life insurance companies, guaranteed. That's safe money, okay? But right here, Stephen just put it up on there. Treasury yields dip as investors await the Fed update. So
and if you read this bottom part, Chris, real fast, this is what I think you're going to talk about here in a second, but just how it's inversely related.
Hold on, let me just put the camera on that.
Sorry, did it pop up? So if you just read this last little sentence right here, this is what we always talk about.
Do you want to read it? I'm looking at it through this. I can't really see
it. Yeah. So U.S. Treasury yields were slightly lower Wednesday ahead of the policy decision. The yield on the benchmark 10-year Treasury note dipped 1.1 basis points to 1.77. The yield on the 30-year Treasury bond was 1.4 basis points lower. Yields move inversely to prices, and 1 basis point equal to 0.01%.
Absolutely. So that's definitely where we're going. And, TikTokers just got a good view of my cat, who is not letting me do much of anything because he's sitting right in the freaking way. But anyway, that's just what cats do. So when the markets and when the interest rates are at historic lows, people don't want money in safe places. Treasury bonds, like he just said, he just gave you the rates. How many of you want to park all your money in treasury bonds earning those low interest rates when inflation is 7%? I bet you most of you that don't understand what I'm going to explain next say zero. I don't want any of my money there. I'm losing money. Well, you're losing money in savings accounts. You're losing money in checking accounts. You're losing money in CDs due to inflation. If you're not hedging inflation or at least beating 7%, you are losing money. 7% is a difficult number to beat. Most of you are not even earning 7% in the stock market in riskier assets, but at least most of you have had a better shot of beating inflation in riskier assets. But this is where the problem begins. Why are retail investors flowing money into the stock market? It's because they can't get the returns they need in safe places. The same thing falls true for institutions. But the institutions have research teams. They understand what I'm trying to tell you. They do the research on this. They know what's coming, but they're the first in. They're in way before you are. Most hedge funds get in actually too early. And usually they suffer losses. And, a lot of people, I see it all the time. They're like, well, hedge funds, they never even beat the markets. By design, they don't beat the markets, folks. Hedge funds don't take the risk you do. They do research. They invest in things that have long-term goals, long-term big gains. And in the middle, they do lots of really cool stuff that is definitely not correlated to the markets, that they make a little bit of extra money. But hedge funds are not designed to beat the markets. Their investors don't care if they beat the S&P 500's 20 or 30% return. They're good with a 9% return. They're sometimes good with a 7% return. But right now, they understand what's coming. So when everybody else is plowing money into the markets, big money is leaving the markets. Okay, so one person's leaving the markets, going to safe places. Other people are plowing money in because they're like, oh my God, I can't lose 7% to inflation being in Treasury bonds when Treasury bonds are only paying 1 to 2%. So there lies the conclusion. And there also lies one of the biggest misunderstandings that I'm going to give you. And this literally is worth, God, this could be worth $10,000 to you. This could be worth hundreds of thousands of dollars. So pay the fuck attention to what I'm going to tell you here. Treasury bonds are going down. The price of the bonds are going down. Why? Why would I want to buy them? The price is going down. Well, of course the price is going down. What did I tell you the Fed minutes said? They said interest rates are going to go up. And that announcement just said that the price of bonds are going to go down because the Fed's going to be talking it to. And they're worried, the bond investors, the people that are buying bonds are worried that the Fed is going to say, we're going to start raising rates now, which would be bad for treasuries or any bonds because the price would go down. But let me ask you a question here. If you're an investor, what is the number one thing you need to understand about investing money? Can anyone give me that? I'll give one person a book. What is the number one, the 3 rules that every investor should follow when investing money? Can you tell me what it is? Let's see. Can we get it from TikTok? Can we get it from YouTube, Facebook? We're streaming everywhere. What are the 3 things you need to do to make money in markets? And I'm going to give you a book. Really? Nobody knows what the 3 rules are? Everybody's sleeping? Everybody needs some coffee? Okay. One person said take profits.
There you go.
I said 3. I need all 3. We're getting them.
So Lynn Green got it in the comments over here.
Lynn Green got it. Buy low, sell high, and don't lose money. So TikTok, you guys were getting it, but I needed all 3 of them. There you go. Someone just got over here on TikTok. So Lynn, we're going to give you a book. Just let us know. Do you have Mapping Out the Millionaire Mystery? Do you have Private Money Guide? Do you have Richest Man in Babylon? We'll give you a book. But here's the deal. Buy low. Let's just focus on the most important criteria. Why do hedge funds underperform the market? Because they buy low. They get into equities. They get into positions when it's low, but sometimes it's too early. So Treasury bonds, we know factually that the price of Treasury bonds would go down. The price of any bond, for that matter, goes down when interest rates go up. So when should you be buying Treasury bonds? Should you be buying them when the price is going up or when the price is going down? When the price is going down, right? So right now, the price of Treasury bonds, factually, no speculation, are going down and will continue to go down with each rate increase the Fed does. And we already know it's going to be 3, 4, 5, or maybe even 6 rate increases in 2022, which is going to stunt the stock market, but it's also going to drive the price of bonds down. So I am buying 20 and 30-year U.S. Treasury bonds because I understand this. Bond prices go down as interest rates go up, making for a really good buying opportunity because you get to buy these assets low. But then some of you are like, yeah, but Chris, there's no return. Treasury bonds are guaranteed by the U.S. government. Now, you have to put some faith in the U.S. government that the U.S. government is still the nicest house in a shitty neighborhood when it all comes down to it. But if the price is going down and I'm buying, but what is my yield? 2% or less. I'm making 2% or less. So yes, I am automatically losing money to inflation. But you see, you have to understand the flip side of it. What is the next thing that is probably going to happen? You've been seeing it already in the markets, folks. If the Fed raises interest rates, if you continue to have these things happening, what is the very next thing that will happen to the markets? Can anyone tell me what's going to happen next? What is the big storm? What is the next thing that will happen? We don't know when, but when it does, what is it? What's going to happen? Can anyone tell me? It is so easy, Treehouse. Let's see. Come on. List the books again. I will in a second. Crash, right? Crash, recession, all real estate collapse, tapering. Tapering is part of what I'm going to get into next. So all these things will result in the markets going down. Now let's go back into the history that I was mentioning earlier. And sorry, I'm taking you on a journey here, and I hope you're paying attention. What does the Fed and the government do when the markets crash, when real estate collapses, when things start getting out of hand and go down? What do they do with the pandemic? What's the first thing the Fed does? There's a lever that they pull. What is it? Interest rates. What do they do in every other period of time going back to let's just go back to the Great Depression. What was the first reaction? Let's drop interest rates. Let's make money cheap. Let's make it easy for people to get credit. Let's print money. So now the next part that I really need you to understand is why Treasury bonds might be a great safe haven short term. I'm not talking a long-term play here. Don't. Let me make a very firm warning on this. Don't buy Treasury bonds for the long term. Rates will go up, okay, in time. And I don't think you should be in these long term. I just want you to understand how to play the short term little thing. This is almost like a little wealth hack. So the Fed pulls the interest rate hammer after they raise them a couple times this year, which is, I think, the thing you're not looking at. You think they're raising rates to curb inflation, which they are, but they're also trying to get the interest rate lever back up so that they have some ammunition in the gun. So when this thing does collapse, they know it will, they can pull that lever again and stimulate the economy. If interest rates go down, what happens to the price of bonds? If they're inverse to, if you know what happens when they're going up, price of bonds goes down. Wouldn't it just make sense that when interest rates come down, the price of bonds goes up? So now let's talk about the rules again. Buy low. We know how to do that now. Treasury bonds, 20 and 30-year U.S. Treasury bonds. There's ETFs out there that have an average of 20-year duration. Don't get caught up in the 20 or 30 year. You don't have to hold these bonds. They're the most liquid investments you can ever buy. Everybody wants them when things fall apart because they're the safest and they're guaranteed by the U.S. government. So don't think, oh, Chris, I don't want to buy one of those 10 or 20 or 30-year bonds. I don't want to hold that for 20 years. I'll be dead. Good. Hold it until this next event happens, because when rates come down, your bond prices will go up. So what that is called, just so all of you that are not paying attention know, that is called a risk-free return. You know who understands this? Banks. Because where do banks put their tier one capital? There's only two places: U.S. Treasury bonds. Why? Because they understand this, because it's guaranteed by the U.S. government. And what's the second place? BOLI, bank-owned life insurance. Exactly what we talk about every single day of our lives. So that's banks. But how about insurance companies? Where do giant mutually owned insurance companies, even publicly traded insurance companies, where do they keep much of their surplus money? U.S. Treasury bonds. Who knows how this works? They do. Who doesn't? You don't. I just explained to you literally a wealth hack, but what you've got to do is you've got to buy and dollar cost average into these things as they keep going down. They're already going down. I bought more yesterday, and I will continue to keep buying. I have a large position in U.S. Treasury bonds, long term. And I will keep buying them because I understand that eventually when this whole thing blows up and the storm hits, Fed will pull rates, my bond prices will skyrocket, and I will sell. And there will be more than enough buyers that will want to buy them. My return, based on the math, because it is a mathematical equation, should be about 30%. Yours will vary. It might not be that, but I just still want you to understand. How many of you want a risk-free return? How many of you are looking for a safe place to put your money? I just told you where it is. There's really only two places that I put my money: Treasury bonds and privatized banking policies. That's it. So I hope that was helpful. I hope some of you listened and paid attention. And let's see, did anyone hate on me for that? Short-term bonds and sell. Short-term bonds are great, but you got to be careful with short-term bonds because it won't have that big impact. If you're buying short-term bonds, that inverse relationship will be much reduced. That's not the right way to say it, but it'll be a lot less because you're playing the short-term game. The long-term bonds are the ones that will have the biggest move in price when this event happens. They will also have the biggest move in price when the price or the interest rates go up. So again, you could do the short-term bonds, but I prefer the long-term because it's a better play for what's happening right now, the environment we're in. Not discounting short-term bonds is a great strategy. Diversify. Have some short-term, have some intermediate, and have some long-term bonds. They will all play out the same way. Just make sure that they are high-quality bonds, not those shit high-yield junk bonds. Those things will go down just as fast as your stocks. And for those of you that think, oh, well, I'm in this stock, there's no way that stock's going to go down. I hear Google all the time. Google is probably one of the safest long-term bets because Google ain't going nowhere and we become more and more reliant on them and they have all the data. So Google's a great long-term play. If you could handle the movement in the stocks, then Google's a good long-term stock to own. And there's many other companies like Google that you should maybe look at. But here's the thing you need to understand. If you've ever been at the beach or been at an inlet of the ocean, what happens when the tide goes out? Don't all the boats in that inlet and that harbor go down? And then when the tide comes in, all boats go up. I don't care what stock you have. I don't care how great of a company it is. All of them will ride the wave. They will all flow with the tide. So the Treasury bonds will be the only thing that will have an inverse reaction and will be different than your typical stocks. All right, Stephen, I went long on that. So that was too much. Where are we at here?
Yeah, I mean, we just to kind of show you, this is already happening. Like, people don't realize it because again, we hear so much positive stuff on the online stuff. But just to reinforce, I mean, in the last month, the Dow's down 5%, the Nasdaq's down 15%, the S&P is down 9% just over the last month. And then when we look at people like Jim Cramer, I mean, if we remember this from back in the summer of 2020, when Cramer came out and he said, listen, there's many companies where earnings matter, but there's a handful of stocks where they don't mean a thing. And he came out with what he called his magnificent 7 stocks that he was recommending buying at the time. And to say that earnings don't matter when buying a stock in a company is mind blowing to me, right? But that's the world we've lived in for the last 2, 3, 5, 10 years of our lives since the Fed's started doing all this since the 08 collapse. So just to give you an idea of this, so when Cramer was suggesting this, these are what they were, and these are where these stocks are now. His Magnificent 7. Just listen to this. Peloton was at 160. It's now at 26.
Wait, Netflix, is that one of the ones he recommended?
These are the 7 he talked about. His magnificent, you guys can watch this. It's on YouTube. His Magnificent 7. These are them. Peloton 160 down to 26 right now. Netflix at 690 down to 390 right now. PayPal from 320 to 163. Roku from 475 to 152. Square from 290 to 118. Tesla is the one that he kind of got right. Tesla's been the outlier, but even that was a high of 1275. We're down to 943 right now. And Zoom went from 575 at the time down to 147 right now. And we're projecting all of these stocks to continue to drop. And again, Tesla being the outlier there. Maybe be careful with that.
Dude,
but
so
it just goes to show you these things, in real life that are happening right now.
Dude, we need to do a whole training on that one thing. So Cramer's out there. Cramer's a big name. You got to kind of like the guy. He's got a lot of energy. He's out there telling people that those are the 7 stocks they should own. And if they did and followed his advice, which a lot of people did, I bet you, dude, that's the difference between retiring and not retiring. That's the difference between your family feeling, financially secure to your family being like, oh, F. I should have just said it, but you get the drift. Like, that's insane. Folks, you got to be very careful who you take your advice from. You're taking your advice from your advisor. No disrespect to any financial advisors. There's some really good ones out there, and we're bringing one who runs family offices on our show. But your financial advisors, your Jim Cramers, they're making suggestions that benefit them. I don't care what they tell you they're doing and why they tell you they're doing it. Mark my words. Advisors get paid for having you in the market. They don't get paid for telling you, hey, listen, you should open a TD Ameritrade account or a Schwab account, and we'll buy some of that, those 20 and 30-year treasuries. Maybe we'll buy an ETF. TLT is the one that Harry Dent talks about all the time. Some of you are asking, where do you buy U.S. treasuries? There's 2 places easily. Google how to buy U.S. treasury bonds, and the U.S. government website will come up. You can buy them directly from the U.S. government. The second place is just any of your brokerage accounts, Schwab, TD Ameritrade, any of them. It doesn't, E-Trade, any of them all have the ability for you to buy them. You can even buy ETFs that have exposure or an average of 20 plus year US Treasuries. The one that I own, and this is not a recommendation, not a suggestion. I'm not telling you to buy this. I'm not suggesting this, but in my portfolio, TLT is the one that I've been buying. Again, do your due diligence, make sure you consult with whoever you work with, blah, 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 disclaimer. But that's what I'm buying. That's how you buy them.
And Cindy said Peter Schiff is differing with some of the things that we're saying right now. And
100%. So is Jim Rickards. I get it.
Well, here's the thing, though, is there's actually Peter Schiff, Harry Dent did a debate probably about a month or two ago. And they've really got deep into all the stuff we're talking about right now. So yeah, Peter Schiff has his thoughts on gold and thinks gold is 100% the way to go. Stay away from treasuries and all this stuff. Harry Dent has more of a picture like we're talking about where, hey, these US treasuries are going to be great because it's inverse and what's going on with the Fed and everything. So definitely different ways of looking at it. And then you turn on CNBC and they're saying buy more stocks. So who the hell knows? But we're laying out, history. We're showing you what we're seeing right now. You guys make your decisions. At the day, Kramer is an entertainer. At the end of the day, this is an entertainer. So you decide.
Yeah. Your internet is cutting in and about, but here the Bry guy 918 on TikTok has asked the same question a few times. I guess he's really concerned about this. He said, is there a penalty for selling long-term bonds? So let me quantify that. Long-term US Treasury bonds, is there a penalty for selling them? No. The price fluctuations will happen based on interest rate moves in different economic things, but no, there's no penalty for selling them. They're one of the most liquid investments there is, period. More liquid than Tesla stock, more liquid than Google. More people want treasury bonds than anyone else. And who wants them? Mostly institutions and China and insurance companies and banks. And shall I keep going? So no, there is no penalty for selling them unless you sell at a discount or for less than what you paid for them. And you just got to basically do your own due diligence on that. So let's hit this Peter Schiff thing, because I urge all of you to watch the debate. It's on YouTube. You can go on and type in Peter Schiff versus Harry Dent, and I'm sure it'll pop up. But, all economists, and we follow lots of them. We follow Grantham. We follow, and we got a video.
I got an article on that in just a second.
Yeah, Jeremy Grantham will play that. This dude's a genius, believe me. Like, you want to listen to somebody, Jeremy Grantham and Warren Buffett. You should be following them before they're no longer here, because they're both pretty old, but they've got unique takes. But when you look at The Economist, I read books, lots of books by Jim Rickards. Okay, he's The Next Great Depression, The Death of the Dollar, or, there's different books that he's got out there. But I follow a lot of stuff. I was just watching some interviews with him. So he's a gold bug, as is Peter Schiff. Peter Schiff loves gold. And I'm not discounting that gold's a great thing. And in our portfolio suggestions that we have out there, we definitely have gold and precious metals in there. I think gold is great. But you got to understand, when we're talking about treasury bonds, we are not talking about buying treasury bonds long term. We are talking about holding treasury bonds for one specific event. We're buying them when they're going down, and then we are going to exit them when this event happens, when the storm hits and the Fed pulls interest rates. You're out. You'll see the price spike. You got to get out. If you hold them long term, the return versus, that's not really a risk because they're guaranteed, but the return just will not be good. So when Schiff and Rickards are talking about treasury bonds and saying you shouldn't do this, when your advisor is saying, oh my God, treasury bonds are the worst possible thing, that Chris guy and Steven guy, they don't know what they're talking about. Understand this. We're not saying buy government bonds and hold them long term. We're saying buy government bonds for a short-term storage of your capital and then wait for the event. And when the event happens, you will make a risk-free return mathematically, not speculatively. You will make this return and you sell. If you fail to sell and you're like, oh, I'm just going to hold these things, these are great. The price of those, or the return you made in that event, will slowly dissipate. Just look at a chart. Pull up a chart. You don't need to be good at reading charts. You will see. Look at 2008. Look at every other period. Look at the .com. Go back in the 80s, the 70s, the 60s, the 50s, the 40s, the 30s. You can look at every one. Look at the highs and the lows, and look at the time frame, and then parallel that back to what happened every time, folks. It's just how it is. It's the biggest thing that all financial advisors have to learn when getting their Series 7 stockbroker license. It's the biggest section of the stockbroker exam. Why? Because it's fucking important. And yet too many people forget what they learned when they become an advisor, and they buy into the rosy colored glasses of what their brokerage and their consultants tell them to do, which is usually leading you off of a cliff. I'm sorry, but it is. I'm not making any money. You can't invest your money with me. Don't even ask. I don't want to manage your money. I want you to manage your own money and be a good steward of your money. That's the difference. I don't give a shit what you do with your money. Protect your family, protect your financial future. Fucking listen, because I don't have an economic gain. Your financial advisor absolutely has an economic gain for what they do and what they tell you to invest in. I do not. I don't care. I don't want your money, and I'm not trying to make money off of you. I'm trying to tell you factually what happens and what the big guys are doing.
Yeah.
Anyway, let's move on to let's talk about Jeremy Grantham.
And Matt, real fast, Matt was saying, trying to follow logic, would bonds actually be cheaper in a couple months after the next rate hikes happen? But that goes back to timing the market, right? I mean, you never want to try and time it perfectly. So this is when we talk about dollar cost averaging in. This is just buying in on a regular basis as things do happen. And then that way, as they start to rise back up, you're getting in at the bottom and you're dollar cost averaging in, and then you're taking advantage of the entire trend.
Yeah.
Kind of
I can't read it, but little bit stormy. I like that name. A little bit stormy. It's a little bit stormy out there right now. Said Treasury bonds need to be a long term. I don't know if they mean hold long term or the long term Treasury bonds. I would suggest you can mix it up and diversify. Do 10-year, do 20-year, do 30-year. But I like the longer term ones because they have that bigger pop based on those inverse relationships to interest rates. You can do whatever you want on that. You're very welcome. Yeah, thanks.
Yeah. Right. So last week we had on a guest, from the audience, that had great information on crypto and whatnot. Yeah. This article was actually submitted from another viewer of this podcast. I believe it was Jim, wasn't it, Chris, that sent this?
I think so. Yeah, I think Jim gave us this one.
And I see him on right now. So Jim, thanks for sending this over. So
yeah, thanks, Jim.
When you guys share articles that you see, things you think that are relevant, and if you feel like you have some knowledge in a specific topic, reach out to us, and we'd love to bring you on as a special guest for half the show or something like that. Would be a lot of fun. So Jim sent this to us this last week, so I wanted to bring it up. And as Chris said, Jeremy Grantham, is a world-renowned economist, and he's saying this super bubble will soon pop, taking stocks 50% or more. So
yeah, well, just so everybody understands the 50% thing, because this is a number that's being thrown around a lot. How do they determine it's going to go down 50%? Are they guessing? Not even close. It's all levels, folks. It's support and resistance levels. It's moving average levels. Believe me, when it goes, it will go between 50 and 60% on the first leg, which is the first dip, if you will.
Yeah, and he said, in a bubble, no one wants to hear the bear case. He said it is the worst kind of party pooping, but he's making the case to the world, to those that have seen in the Great Depression in 1929, the dot-com bubble of 2000, the financial crisis of 2008, and he's saying we're going to see a similar crash. So it's interesting. And, back to what you were saying earlier, Chris, about how the bond market, the treasury market, it's one of the biggest parts of the Series 7 exam for financial advisors and stockbrokers, and how we've just kind of fucking forgotten our way, and it goes to show it when you start talking about, because there's all these shiny objects out there, and that's just human nature. I mean, you see crypto up, 100,000% in a year, and it's like, holy shit, well, let me chase after that. And then you see, the main stocks of AMC and GameStop, and holy shit, let me chase after those. And you kind of lose your way. And that's what causes a lot of these problems that we're going to see coming up here.
Yeah, and it's interesting, when we talk about AMC, and on this show, we've talked extensively about the GameStop and AMC thing. And I will tell you, even myself, with our hedge fund and with my full-time trader, we got it wrong on GameStop. I remember the big Reddit thing where GameStop was running up to $500. Like, that stock in its best day is a $20 stock, not even close, but in its best day. And we were on the short side. We were just like the institution shorting that. And we got squeezed on the short. We luckily got out because we waited, and we were able to carry our margin and continue to keep depositing money to keep up with our margin requirements as that stock kept going up, and we're in a short position. So when we're shorting GameStop and the price keeps going up, our margin requirement grows and grows and grows. And we start getting notifications from TD saying, we need more money, or we're going to call your positions. And it's a dangerous position. And that's what you saw happen with all the hedge funds that were in that. And I think Burry was one of them. They had such large positions that as that stock went up and up and up, and Reddit knew how to play this thing, the investors there up and up, they squeezed the hedge funds out at major, huge losses. We luckily were able to cover it because we had a very small position in retrospect, but we were able to cover until the stock actually pulled back and we exited, but we hardly made anything. Shorting the market right now is very difficult. don't try to short the market. You hear about hedge funds doing it, but just please don't short the market. You will most likely get burned because the markets do not react in logical ways. They don't react in fundamental ways. Nothing that the markets are doing right now makes any sense. I mean, come on, how do you go from 1,000 points down to a positive day? You think that makes any fucking sense? It doesn't. So pay attention and don't play into that. Don't play into the Jim Cramer bullshit or anything else. Like, just be logical, folks. Logic will get you through this. FOMO, following the gurus, listening to the wrong people that don't have the knowledge through wisdom and time and failure, like doing that will certainly get you into a dangerous place. Crypto. Everybody on TikTok keeps saying, well, what about crypto? What about crypto? What about crypto? Well, let me tell you what I've been doing. Crypto's been going down, 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 right? What have I been doing? Buying, 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 buying. I bought all the way down to the low point into the almost 30,000. And now it's what, 36 as of this morning. So I'm doing pretty good. Okay. But most people bought crypto where? 40, 50, 60. Why? Because it felt good because it was going up. You don't want to play that game. When things feel like you should buy them, more than likely you should not be buying them. You should be selling them. And when things are scary to buy, when things are like, oh my God, I don't know if I should do this, that's probably when you should freaking buy. How many of you, seriously, like TikTok, please, because TikTok's big, and Google and YouTube and Facebook, please tell me, and Instagram too. Be honest with yourself. How many of you have been buying the dip in Bitcoin? I don't care what your Bitcoin and Ethereum, all those other coins, like you guys can have them, but like Bitcoin and Ethereum, how many of you honestly, don't lie, have been buying this dip? Just say I. How many of you have been doing that? Because everybody wants to know crypto. How's crypto? Crypto is correlated to the markets. When the markets go down, crypto goes down. Wake up, folks. Wake up. Okay? It's not gold. It's not the same the same, defensive position as gold. It is following the markets. The markets are following crypto, whichever one. How many of you have been buying?
We've been saying that for years, and it's starting to come out more and more now.
Yeah. So, all right, a bunch of people on TikTok are saying that they're buying, which is good because that's what I've been doing. But now that you've bought, we have to now apply some of the rules of investing. Where are you going to sell? Honestly, at what price are you going to sell? Oh, I'm going to sell when it goes up. Wrong answer. You just lost all your money. I'm on a tear today. I don't care if I'm being an asshole. Like, if you don't have an exit, if you don't have a trading strategy, a plan of where you're going to exit, you will more than likely lose all your money. Now, if you're a long-term Bitcoin holder, like if you buy and you're like, listen, I don't care what the price is. I understand the utility. I understand the value, and I understand what it does. And I understand that there's no intrinsic value. I understand that there is no fundamentals behind Bitcoin. It is all investor confidence. But if you're bought into what it does and what problem it solves, buy it and hold it for the long term. Ignore price. Don't even open it. Just continuously dollar cost average in. Set it up in your Coinbase or whatever account you use. Set it up that every week you're going to buy $10, $20, $100. That's what I do. But then when the dips come, I buy big chunks. Just last week, I bought over $10,000 of Bitcoin and Ethereum. And I will sell both of them at a specified price, which I'm not going to tell you because I want you to determine your own price. It's very easy to see, folks. Look at the levels. Go through and draw straight lines across as to where the Bitcoin or the Ethereum has touched. Get 3 or 4 touches on one level. Boom, you've got your floor or your ceiling. It's not hard. But if you just buy it with no intentions of selling it because you're like, oh, I bought low, finish the game. Okay, the Buffalo Bills game that just played where we lost like in overtime. They didn't say after overtime, oh, we won the game, we're not going to play anymore. No, they finished it and they lost. Oh, well, good game played. Hail the Chiefs, whatever you want to say. I'm simply saying professional athletes finish the fucking game. So you need to finish your game. So if you bought, where are you going to sell? Set that line, draw the line in sand, and when it hits that, you're out. Is it 40,000? When it hits 40, I'm out. I bought it at 32 and I'm out at 40 or 42. Great. Sell it when it hits there. Don't be like, oh, I think it's going higher. Then your money will flee you if that's the thing you follow. All right.
Yeah, for the record, I'm not an attorney, and this is not legal financial advice. Our advice to you is plain and simple: buy tennis balls; they have the highest rate of return.
That's right, and that's probably your dog. So cats love tennis balls too. So just buy lots and lots of tennis balls; they're not going anywhere. I love it.
Oh man, yeah. In other news right now, we do have earnings week going on. Earnings season is here right now. So,
but Kramer said earnings don't mean anything. So why are we even talking about this?
so for some stocks, he said. But yeah, I mean, earnings still do mean something, in the real world, and it's earnings season right now. So we've been kind of keeping our eye on a few of the bigger players. Monday, IBM. Tuesday, Johnson & Johnson. Microsoft, Verizon, American Express, GE, Capital One. Today we got Boeing, Tesla. Actually, Tesla's going to be after hours today, I believe, at 5:30, and that could be a big one for Tesla. They're expecting some pretty good earnings, actually. AT&T, Intel, and NASDAQ also today. Tomorrow we got MasterCard, Apple, McDonald's, Visa, Blackstone, JetBlue, and Robinhood. And then Friday, Chevron and Caterpillar. So we'll see what happens with all of that.
It's going to be interesting. Earnings have really, because fundamentals are kind of out the window right now, which is why Warren Buffett really isn't buying anything, because he's a fundamental investor. You guys should all read his book. But do earnings really matter? Are they really going to move the needle? For institutions, yes. For the retail investor, probably not. No one's probably even paying attention. But, they do matter. They normally matter more in an environment where things aren't just crazy like they are right now. So again, it's just earnings are coming up. What is that going to mean? Well, we're going to find out. But I think the bigger news is what the Fed says this afternoon. I think that's what everybody's on pins and needles about.
Yep, 100%.
That's what I want to know. What is the Fed going to do? It's not so much the raising of the interest rates I'm worried about. That just gives me a good buying opportunity, because we know that they're going to raise rates to curb and taper, or to not taper, but to curb the inflationary concerns. And because we now behind the scenes know they need to get rates up, because if something does happen, they need some bullets in the gun, if you will, or some powder to basically make that stimulus happen with dropping rates. You don't want to be Japan. But the other thing too that the Fed made aware that kind of hit Wall Street, it'd be like a sucker punch, right? You're at the bar and somebody left hooks you and you're not expecting it. What the Fed said in December, and I said this last week, is that they're going to begin to taper, which means they're going to slow down the amount of bonds that they're buying, which in other words, they're going to start slowing the printing press down. They're going to taper the bond purchasing programs, which means they're going to slow down the easing. So when they do that, okay, we already kind of knew they would probably eventually stop buying so many bonds, which that will take liquidity out of the markets. It will slow down the economy and the markets. So be aware. But the other thing that they said that nobody really is talking about is they said that they're going to begin selling some of these bonds. Okay, they're going to, and they didn't say sell the bonds, because you would have been like, oh, that's what they said. No, they didn't. They said we're going to unwind the balance sheet. They got these weird words, and you got to read between the lines to understand what that means. Unwind the balance sheet. What's on a balance sheet? Do any of you not know how to read a balance sheet? Because if you don't, that's where you start first. If you can't read a balance sheet, don't ever buy a stock. Learn how to read a balance sheet first. It's a fundamental. That hedge fund manager has a great training course on how to fundamentally analyze stocks like a hedge fund. He's also got a book. I don't mean to keep going there, but sometimes you got to get your knowledge from the people that understand this. Ray Dalio, read his book. Warren Buffett, read his book. Read Warren Buffett's mentors' books. Not Graham Stephan. Holy crap. Yeah. I got YouTube and Warren's mentors all confused. But anyway, you get the drift. So what I'm trying to say is unwinding the balance sheet means they're going to start selling bonds in the open market. That is going to be tragic, because it is going to suck liquidity out of the stock market. And if you suck liquidity out of the stock market, where do you think that's going to lead to? So you're going to raise rates, you're going to taper bonds, and you're going to unwind the balance sheet. Start of a disaster, beginning and fuel for the disaster has happened. It will put us into a deleveraging position. And eventually, a lot of you are super concerned with inflation, rightfully so. So are all of us. But I think the thing you all need to study is not so much inflation. You need to study deflation, because that will be the next phase. If you don't know what deflation is, Google it and learn it, because that will be what will happen. So if you're not ready for deflation, but you're ready for inflation, well, that's going to be like another left hook. All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel, and don't ever forget to smash that alert button. We'll see you on the next one.